Gallery, welcome. Let's bring the body in. Tonight's subject is China SXT Pharmaceuticals, ticker SXTC. Before the financing, the patient was trading near $2.02. Days later, the last recorded pulse was 6.98 cents. That is a decline of approximately 96.54%. That is not a pullback. That is a chalk outline with a ticker symbol. Welcome to Wick's Market Mortuary. I am Inspector Wick, Chief Market Coroner. I do not chase stocks. I examine them. Tonight, we determine what killed the SXTC market case, whether the squeeze claims can revive it, and whether any future movement should be called recovery, or merely post-mortem muscle activity. The market is not just a collection of tickers. It is a crime scene. Facts, evidence, analysis, no hype. Let us begin. The collapse report begins on July 22, 2026, pre-trauma pulse, $2.02. The next day, SXTC announced a $9 million financing involving 4.5 million units priced at $2 each. Each unit contained one Class A ordinary share and one warrant. The market read the paperwork. Then it reached for the defibrillator. The post-financing close fell to approximately 33.26 cents. The next recorded low was approximately 6.38 cents. By July 27th, the patient closed at 6.98 cents. Total price trauma, negative 96.54%. The chart did not bend. It fell down the stairs and struck every support level on the way to the basement. Volume also exploded. That confirms attention. It does not confirm health. A crowded examination room can mean concerned relatives. It can also mean everyone heard there may be free coffee. Coroner's assessment, extreme price collapse, financing-related trauma, high volatility, dilution overhang, Nasdaq, and reverse split exposure. Squeeze claim, under investigation. Vital outlook, critical. Now to the incident itself. On July 23rd, SXTC priced 4.5 million units at $2 each. Gross proceeds were approximately $9 million. After estimated fees and expenses, expected net proceeds were roughly $8.3 million. The stated purpose included oncology development, artificial intelligence pharmacy projects, and business intelligence platforms. A noble mission. Unfortunately, shareholders do not pay rent with mission statements. Each unit contained one ordinary share and one warrant. The ordinary share created immediate dilution. The warrant created future dilution capacity. The company received cash. The shareholders received paperwork with teeth. Send the warrant to Autopsy. It included a zero-price exercise provision. As the contractual calculation price falls, the potential share output rises. At the 40-cent calculation floor, one warrant can deliver as many as 14 shares. 4.5 million warrants multiplied by 14 equals approximately 63 million potential additional shares. Potential, not automatically issued, not automatically sold. In this mortuary, confirmed shares and possible shares go into separate evidence bags. The 40-cent floor is not price support. It is not a market bottom. It is only the lowest price used by the warrant formula to calculate maximum share output. The stock could trade below 40 cents because the market price was never handcuffed to that floor. Once the formula reached 40 cents, a lower market price did not create more than the 14-share maximum through this particular mechanism. That does not remove dilution. It only means this instrument reached the bottom shelf of the medicine cabinet. Primary trauma. A dilution device embedded in the warrant. Complication. Potential shareholder value hemorrhage. Now separate the remains. At the end of March, the audited share count was approximately 958,000. Before the July offering, the reported count had expanded to approximately 38.2 million. Adding the 4.5 million offering shares brought the immediate total shown in the timeline to approximately 42.7 million. Under the maximum warrant scenario, that timeline reached approximately 105.7 million shares. Another exhibit in this case shows a later estimate near 83.6 million outstanding and a larger current plus issuable model near 151.1 million. Those figures do not all describe the same thing. One is a reported snapshot. Others are dilution models based on additional issuance. Do not confuse a possible body count with bodies already on the table. Confirmed shares are in the room. Contractually issuable shares are waiting outside. Broader financing capacity is still circling the parking lot. Potential dilution is not confirmed dilution, but it can still cast a very large shadow. The toxicology report did not find one poison. It found several.
Dilution,
Aggressive financing, reverse split risk, weak operations, Nasdaq exposure, promotion and squeeze narratives. One toxin can damage an organ. Several can reserve the chapel. Now examine the financial blood panel for the fiscal year ended March 31st, 2026. Revenue was approximately $1.14 million, down 34.6%. Gross profit fell to approximately $249,000. Operating loss widened to approximately $7.12 million. Net loss reached approximately $6.21 million. Operating cash burn was approximately $4.02 million. The operating margin was roughly negative 626%. When the margin requires 3 digits and a minus sign, the lab technician stops asking whether you have been fasting. There was one important positive. Cash and restricted cash totaled approximately $28.2 million. The current ratio and conventional debt levels also looked healthy at the fiscal year cutoff. But the source of circulation mattered. The company received approximately $14.4 million from financing activities while operations consumed roughly $4 million. The patient still had blood. It simply was not producing enough of its own. Liquidity came from the capital markets, not from a healthy operating heartbeat. The same panel shows how quickly the share count expanded from fewer than 1 million shares at the end of March to more than 38 million before the July offering. The balance sheet had liquidity. The operating organs were failing. The capital structure was receiving repeated transfusions. There was also a separate SmartMart financing arrangement. That facility described potential cash funding of approximately $30 million and a registration covering as many as 157.5 million potential shares under its 20-cent floor scenario. Again, potential shares, not proof that every share was issued or sold. But an overhang does not need to enter the house to block the sunlight.
now watch the clocks.
2 clocks. One dangerous neighborhood. The first came from the financing and reverse split paperwork. 3 consecutive qualifying closes below 10 cents could satisfy the contractual condition, allowing the board to move toward another reverse split announcement, subject to timing and board discretion. As of the July 27th close, SXTC had recorded 2 consecutive closes below 10 cents. A third qualifying close could complete that condition. The agreement did not permit an announcement before July 30th. That does not make a split automatic. It only means the operating room becomes available. The surgeon may act. The surgeon is not required to act. The second clock belongs to Nasdaq. If the closing bid remains at 10 cents or less for 10 consecutive trading days, Nasdaq staff shall issue a delisting determination under the low-priced security rule, subject to the company's hearing rights. This is separate from the standard $1 deficiency process. Do not confuse the clocks. One may open the operating room. The other may close the building. The SmartMart 20-cent floor is not another clock. It is a financing formula from a different hallway. Now review the surgical history. 5 reverse splits since 2021. 1 for 4, 1 for 20, 1 for 25, 1 for 8, and most recently, 1 for 150 in February 2026. Combined, approximately 2.4 million original shares became 1 current share before fractional share treatment. That is less a surgical history than a recurring admission. Nasdaq's excessive reverse split rule generally removes the ordinary minimum bid compliance period when a company completed a reverse split during the prior year, or cumulative splits totaling at least 250 for 1 during the prior 2 years. SXTC meets both historical conditions. Therefore, another standard 180-day compliance window is not a guaranteed escape route. A reverse split may raise the quoted price. It does not create revenue. It does not repair losses. It does not erase dilution. It merely changes the size of the body bag. A reverse split is surgery. It is not resurrection. Now to the squeeze claims. The newest settled short interest report used in this case showed approximately 22,500 shares sold short as of July 15th. Days to cover were approximately 1. Estimated short interest was around 0.1% of float. That is not enough reported short interest to establish a traditional squeeze setup. Borrow fees were elevated and screenshots circulated showing an approximate rate near 12,000%. That figure was time-sensitive. It was also not settled short interest. A high borrow fee can mean shares are difficult or expensive to borrow. It can also reflect a very small lendable inventory. It does not prove that a large short position is trapped. Daily short volume is not the same thing as net short interest either. Market making, hedging, and liquidity activity can all appear in those totals. The daily volume reached approximately 340 million shares compared with a historical average near 141,000 before the disruption. That confirms extraordinary speculation. It does not confirm hundreds of millions of trapped short shares. Could the stock still move violently? Certainly. Momentum traders, temporary selling exhaustion, low float dynamics, and speculative buying can all produce squeeze-like volatility. But the confirmed evidence did not establish a structural short squeeze. Official short interest, extremely low. Borrow fee, elevated. Momentum and liquidity, extreme. Dilution risk, severe. Verdict, not a verified squeeze setup. Now, place the two files side by side. The bull case is built on momentum, heavy volume, elevated borrow fees, low price percentage moves, oversold bounce potential, and the possibility of an unexpected catalyst. The bear case is built on contracts, financial statements, rapid share count expansion, repeated reverse splits, weak operations, Nasdaq risk, and additional financing capacity. One side brought paddles, the other brought the autopsy report. A violent rebound remains possible. A sustainable recovery has not been established. The difference between a bounce and a recovery is that a recovery eventually leaves the hospital. This patient keeps requesting another ambulance. Final diagnosis. This is the Inspector Wick ruling on the market case presented in these exhibits. It is not a declaration that the legal corporation has ceased to exist. The ticker can continue trading. The company can continue filing reports. The corpse can even sit upright for several sessions and terrify the interns. But the market thesis examined here is pronounced dead. Cause of death: chronic financial failure, excessive dilution, Nasdaq non-compliance risk, repeated reverse splits, no confirmed sustainable near-term catalyst capable of repairing the underlying condition, and extreme borrow cost without enough settled short interest to establish a genuine squeeze thesis. The evidence shows declining revenue, widening operating losses, accelerated cash burn, and dependence on financing. The share count expanded rapidly. The warrants created up to approximately 63 million potential additional shares. The separate financing registration covered up to approximately 157.5 million potential shares under its floor scenario. The stock entered severe Nasdaq low-price territory, and the reported short interest evidence did not support the squeeze narrative. Short-term outlook: extreme volatility. Temporary rebounds remain possible. Medium-term outlook: continued dilution and delisting exposure. Long-term outlook: very high risk of total loss. Case disposition. Status: pronounced dead. Final ruling: terminal dilution event, not a recovery candidate. Any movement is classified as a reflex, not a revival. The patient is deceased. Case closed. Gallery: read the filings, respect the volatility, never confuse movement with recovery, and never volunteer to become exit liquidity. I am Inspector Wick, Chief Market Coroner at Wick's Market Mortuary. I do not chase stocks, I examine them. The market is not just a collection of tickers. It is a crime scene. This examination is for informational and entertainment purposes only. It is not financial advice. Do your own investigation before entering the crime scene.